Good evening, and thank you very much for joining us in yet another webinar series. Today, we've got a very interesting personality with us, and the topic for this webinar is the Access Quant Fund. The Access Quant Fund started a couple of years ago. It's just completed 2 years anecdotally. And the best way about how I would describe quantamental investing or quant-based investing is thinking of us as active fund managers. Uh, Today, active fund managers have a very, very peculiar uh, uh, role to play in our markets in identifying what stocks to buy and what to stay away from. Now, in an environment where machines are taking over almost everything, investing also has got an AI or a machine learning or a quant-based attitude, uh, where where certain funds like the Access Quant Fund use machine tools or logic to decipher which stocks to go into and which stocks to stay out of. To explain this a little better, we've got with us Mr. Karthik Kumar, Senior Fund Manager at Axis Mutual Fund, uh, to tell us what he does on a day in and day out basis and what does the Axis Quant Fund do on a day in and day out basis to make you more alpha over a medium to long term. Hi, Karthik. Welcome to the show.
Hi, Shane. Thanks for that introduction.
Yeah.
Let me just share the screen and then we can go.
Yeah. So Karthik, we've got a very retail audience with us. We would want you to explain what you do, first of all, as a fund manager for a quant strategy, and what is quant-based investing. And then a little bit over the next 15 or 20 minutes, delve on what the fund is all about. Yeah.
Okay. So quickly, I'm responsible for managing quant strategies at Axis, and aside from that, I also look at arbitrage. That's the other piece that I look at. But sticking to today, in terms of quant, I've been doing quant for 14 years now, 15 years now, and it's a style of investing that works pretty well in our markets based on my sheer experience. So let's start with the basic building block, right? So what is quant? In my mind, quant is essentially a rule-based, systematic approach to portfolio construction where you let data do all the talking in terms of stock selection. Now, it is to give you an anecdote. So you can think about it like a difference between a manual transmission and an automatic transmission. In a manual transmission, you would basically, you as a driver, you would make the decision of when to change the gears based on what speed you're driving at, what RPM you're driving at, and so on and so forth. Automatic transmission basically takes the same data and makes that decision for you. So in that sense, a quant fund is very similar, where it is leveraging the same data points that a fundamental portfolio manager or an analyst would look at, but just that the decision making is automated and the decision making is very disciplined in that context. So that in a very concise way is how I would define a quant fund. Now, moving on to a couple of things, right? So when we talk about quant fund, the normal perception is that quant funds are passive. Well, quant is a toolbox. You can use that toolbox to create a passive product or an active product. In our case, the Access Quant Fund is a completely active offering. We've got our active share, by which active share is a measure that decides how close or how far away from you are from your benchmark. Active share of this product is upwards of 70%, which effectively tells you that this portfolio is very different from the benchmark, and it is actually making active bets with the aim of generating outperformance over the markets, right? What the markets have to provide. So this is a completely active offering. Second is that SEBI classifies this product as a thematic product, and within thematic, it classifies that quant. But people also think of thematic as being a sector-oriented product. However, in this case, this product is completely diversified, both from a cap perspective, as in it has a fair degree of exposure across large cap, mid cap, and small caps, and it is also well diversified across sectors. So this is not a sector specific fund, it is a sector diversified, it is a cap diversified fund. For instance, If you look at the cap allocation of this fund over the last 2 years, the large cap allocation has ranged between 55 and 75%. The mid cap allocation has ranged between 10 and 30%, and the small cap has ranged between 0 to 15%. So the point being that it's a completely diversified offering, and the cap allocation kind of brings that out in terms of how diverse, how we leverage opportunities across the cap spectrum. And that will also be true across the sector space as well, where there is reasonable allocation to different sectors. Now, going on to the basic building blocks of Quant, right? So what we do within Quant essentially is not a black box. It's what I call as completely white box, and where the inputs are completely transparent. Now, as I said previously, we aim to leverage on the same building blocks or the same data points that a fundamental manager would look at. So to that extent, what we do is we have a universe of around 300 to 350 stocks, and we want to invest. Our end aim is to invest in a portfolio of what I call as QGARP, which is a portfolio of quality stocks with good growth at reasonable prices. So there are three fundamental parameters that we are looking at. One is quality, the other is growth, and the third is valuation. What we want to do is we want to invest in the sweet spot where all the three styles kind of blend in, or identify stocks where it ranks well across all the three metrics, so that your portfolio is well balanced along each of these dimensions. So to give you quickly an understanding of what these styles stand for, I'll start in no particular order. The first one is quality. Now, through quality, what we aim to do is we aim to measure the quality of the company from two angles. One is the quality of the management, and the other is quality of business operations. To do this, we look at historic data through balance sheet, income statement, cash flow parameters, and analyze them and their evolution over time to figure out how good is the quality of the company. The reason we look at historic data is because historic data gives you a good understanding of how the management runs the company, and because that behavior is quite consistent through time. And so a company that has been managed well is more likely to continue that behavior in the future, and a company that has been mismanaged and that kind of behavior is also more likely to repeat in the future. So which is why we look at historic data to completely analyze quality of the company, so that every company in that 310 stock universe gets ranked based on a quality score. The next we look at is growth. Growth is in complete contrast to quality, where we are looking only at forward-looking data. We are looking at growth prospects of the company over the next 2 years. And we are looking at how is the growth prospects evolving, or what is the level and how it is evolving. And we are looking at a range of data points to kind of gauge that growth prospect of that company. And as in case of quality, again, each company is rated based on its growth measure. Now, growth is completely dynamic because, as you know, the growth prospects of the company are constantly changing based on regulatory changes, input price changes, competition out there in the end market, and so on and so forth. So growth is a very dynamic parameter that changes quite frequently. In fact, it changes on a weekly basis. The third is valuations. The aim here is to make sure that you're not overpaying for your positions, and that the whole portfolio is well balanced, considering growth and valuations. And so, to that extent, we look at traditional value metrics, and we look at forward-looking value metrics, because one could argue that the history is already priced in. So we look at forward-looking value metrics to make that decision. So each company gets ranked based on quality, growth, and valuation. And then a total score is calculated, which is basically a summation of the three. And the total score is an indicative of expected future returns. Higher the total score, higher is the expected returns. And hence the weight allocation to that particular stock in the portfolio may be higher. And conversely, lower the score, lower is the expected return. Now, this slide basically reiterates what I said in my previous slide, which is we want to invest in the intersection of the styles, because that's where our sweet spot is, and that is how we define QGARP, which is a portfolio of quality stocks with good growth at reasonable prices, right? Now, once we've got the ranking of the stocks, or in other words, the expected return on the stocks, the way we put together our portfolio is we look at three other metrics: and this is completely from a risk perspective. The first thing we look at is the liquidity of the stock to decide how much weight to allocate to a stock, because that would help us determine what should be the level of what should be the weight allocation of the stock in the portfolio, and that will also, and it will be in a level that is commensurate and make sure that we can enter and exit that positions quite easily. Next is we look at sector level constraints to make sure that we are not taking extreme sector bets in the portfolio and the sector bets are controlled. Third, we look at stock level risk. Now, everybody knows stock level risk is defined by the volatility of the stock. Higher the volatility of the stock, higher is the risk. So the way we incorporate risk is basically, let's say I have an example here. We've taken two stocks, stock A and B. On the y-axis, you have risk. Now, obviously, higher risk is bad and lower risk is good. And on the x-axis, we have expected returns, with higher returns being great and lower returns is what you want to avoid. Now, in case in point here, you've got two stocks, A and B, with similar return expectations, right? One with a return expectation of 4 and the other with a return expectation of 5. But you'll notice that the risk of these two stocks is very different. The stock A has a risk of 11. As you can see on the y-axis, it's much higher. So the risk is 11. And the risk of stock B is 4. So if you think about the return to risk ratio, as is highlighted by the size of the circle, the return to risk ratio of stock B is much better than stock A. So we would allocate more weight to stock B as against stock A. And we do this across all the stocks in our portfolio. We just don't take return into account. We take return given risk into account to determine the weight of the stock in the portfolio. As a result of which, our portfolio is much more controlled, not only from a return basis, but also from a risk perspective. For instance, the beta of this portfolio has been consistently lower than 1 over the course of the last 2 years. So that tells you that this is a much more risk-controlled offering, because people also think quant tends to be riskier, whereas this is a much more risk-controlled offering, as is evident from the fact that the beta has stayed consistently lower than 1. In fact, it is materially lower than 1 through across time. So that's how we blend both return and risk. And then this process gets repeated and on a monthly basis. So we reevaluate and rebalance the portfolio at least on a monthly basis. The other thing to note is, because the stock selection process, the portfolio construction process is quite unique, the other thing is that the overlap that the strategy has with our other existing products within our portfolio of funds is quite low. So the overlap to blue chip is only around 26%, and this data is as of 30th June. So what this tells you is you're getting 70 to 75% new ideas into the fund. So you're capturing outperformance to the different stocks, to different themes, and possibly through different sector allocations as well. So if an investor were to add this fund to their portfolio, they are not doubling down, they are adding a unique offering to their portfolio of funds. And also, as I mentioned, this is a much diversified offering from a cap perspective. So one can almost look at it as like an alternate within a flexi cap category, because the cap allocation is very similar to what flexi cap funds would do, which is around 60 to 80% to large cap, and the rest being distributed within mid caps and small caps. So with that, I'd like to stop and happy to take any questions on the process, on the experience so far over the last 2 years, and anything else on markets in general as well.
Yeah, thank you so much, Karthik, for that brief yet very, very quick assessment. To all the participants, at the bottom right-hand corner of bottom left-hand corner, you've got a small box where you can post in your questions, and I will take them up and get them answered from Karthik. So please do write in as many questions as you would like, and we will get hopefully all of them answered by Karthik today. Karthik, as we start off, if you could first of all just start off with the fundamental question that we often get asked. What is the difference between a standard actively managed fund and quant fund, and why would one consider a quantamental based investing strategy?
Okay. So if you think about a standard traditional fund manager, They would do the research at a company level, in-depth research at a company level. They will do their channel checks, meet the management, and they know a lot about the company, and they tend to concentrate their positions in a. So if you look at a traditional fund, they would have highly concentrated portfolio. Whereas Quant, on the other hand, leverages completely data, and it leverages a range of data points going from historic to forward-looking data points, and even price and volume data to kind of make that decision of which stocks it wants to invest in. But at the same time, this is not about concentration. So this portfolio will have much more diversified holdings. So the number of stock holdings will be traditionally be higher than a fundamental portfolio. What that also means is that the risk is also controlled. Second is the fact that this is a completely systematic process. So human biases and unnecessary interferences are quite limited. This is a much more disciplined process from a portfolio management perspective. Those are the two large differences as to why one would want to look at a quant fund over a fundamental offering.
Yeah, thank you so much. In terms of the way your investment philosophy works, it's slightly more differentiated as compared to some of our core funds. You call it the QGAR. There is a quality overlay I'm given to understand. Can you elaborate on that a little bit more from a more layman perspective?
Okay. So as a fund house, we believe in quality and growth. That is central. So at the end of the day, there is no, for stocks to realize their valuations, or for stocks to reward the shareholders, at the end of the day, there has to be growth and quality as part of that bouquet of offerings. And we strongly believe in that. But here, there is a slight difference in how I'm doing it, where I'm saying I'm not just looking at quality and growth, but I also want to make sure that I am not overpaying for my stocks through valuations. So to that extent, I also am aware of valuations in the stock selection process. And so what we want to do is invest in the intersection of these three styles, which is quality, valuation, and growth. So I may not be able to capture some of the very high, stocks that rank very high in quality and growth, because they tend to have a higher valuation, and I'm looking for a much more sweet. I'm looking for a sweet spot in the intersection of the three styles. So that's the slight differentiation between what we do in our traditional funds and what we do here, which is why the degree of overlap of this strategy to others is quite limited.
Great. We've got our first question from one of our viewers, Mr. Ramki from Hyderabad, asks us, what is the difference between a multi-cap fund and your quant fund? Okay. So I will give you the product construct, Ramki. A multi-cap fund is typically a fund wherein there's a defined allocation to mid and small caps. So 25% allocation to mid caps, 25% to small caps, and the rest can be put in a large cap or a mid cap or a small cap as the fund manager chooses. But a thematic fund by nature, and that is what the Axis Quant Fund is, has a free hand in the way they allocate their portfolio. From a fundamental perspective of the way the fund is run, of course, Karthik can explain that a little better.
Okay. Yeah. So you've hit the nail on the head, and you've answered most points, Shane. Thanks for that. Aside from the cap allocations, obviously, as Shane mentioned, the cap allocation is quite fixed in case of multi-cap, whereas in a thematic offering, I have a lot more flexibility in terms of cap allocations, and hence I can leverage and I can look at opportunities across cap space and make allocations accordingly. So if I find more opportunities in large cap space, then I'd be happy to allocate more to large cap as against mid cap and small cap. So I have that much more flexibility compared to the other category of funds. The other difference is that as of today, at least, most of the funds within the multi-cap space are managed based on a traditional approach, traditional fundamental approach, whereas here the stock selection process and the portfolio construction process is totally based on data and leveraging that data and extracting signals based on that data, and then leveraging that signals to create to pick your stocks and helps your portfolio. So that is the other difference in terms of how the portfolio comes together. And so effectively, those are the two things that would differentiate like a multi-cap product from our Axis Quant Fund offering.
So in essence, you are a quasi-automated fund, isn't it?
It is an automated fund. It is not even a quasi-automated fund. It's an automated fund with very limited human intervention. It doesn't mean that there's nobody overlooking it looking at it from a risk perspective. I'm constantly looking at the portfolio to see what is happening, what is driving the returns, if are there any stocks that need to be looked at. But the interventions will be more of an exception rather than the norm. So, and these have been extremely rare. And I really emphasize the word extremely because it has happened very rarely. So to that extent, the interventions are quite infrequent, and so it is automated for all practical purposes.
Sure, sure. Mr. Janki from Kerala writes to us, Karthik. He asks, in terms of, obviously we like at the start of the conversation, we said we've completed 2 years. He asks, under what circumstances do you believe that a quant strategy will underperform over a medium to long term horizon?
Okay, so the classic example I can go back, because I've been in the markets for long. The classic example I can go back is to May of 2009. See, quant at the end of the day depends on data points to make its decisions, be it historic data points or forward-looking data points. Now, if you go back to May of 2009, which was just after GFC, what happened is central banks all got together and decided to bail out troubled institutions and the markets. And the markets suddenly started reversed and started rallying based on the support that the central bankers across the world were providing, both support in terms of regulatory support, policy support, and also liquidity support. Now, what happens in case of quant is it waits for data to kind of confirm that decision and make those changes accordingly. So in a scenario like that, where your whole world has changed 180 degrees in a span of, let's say, a week, this kind of strategy can underperform because I'm waiting for data points to make sure that there is rationale to invest in certain stocks and certain sectors. So there will be that time gap then. Now, one could argue even whether a fundamental manager would be able to capture such a sharp turn in that scenario, but that there is at least that possibility. Whereas with quant, we would wait for a confirmation at a data point level. The other example would be, let's say, a new management takes over in any particular company A, right? Typically, we've seen that based on the management that is coming in, the market would make a call that this will be good for the company, and the company starts rallying. Well, I can't do that because I have to wait for data to improve, and that could be forward-looking data. So typically, what happens in such scenario is that when a new management comes in, the market evaluates the steps that the new management is taking, and if that is materially different from what the old management did, and if it will have an impact on the company fundamentals. If it does have an impact on company fundamentals, then I pick it up through signals and the stock starts rallying. So in scenarios like this, I will have a slight time lag in terms of picking up that stock because there is lag in that. But mind you, it doesn't happen that every time a management comes in, the fortunes of company reverse, because a market might be initially optimistic only to realize that the management is no different from the older management, and then the stock starts giving up all its gains. That has happened too. So those are just examples of when quant can be late to the party.
Sure. And this will, of course, imply that this fund would be a typically higher churn or relatively higher churn portfolio. Is that assessment true?
Quantitative funds by definition tend to be higher, slightly higher from a turnover perspective.
Sure. Great.
Because our holding periods tend to be a bit shorter as well.
Sure. Another question that is popping up quite frequently here is in the current market space where valuations are fairly elevated, and you've got a whole host of negative perceptions going on. How is the quant fund being tuned or being geared up for a possible downturn? Okay. Is there something like that you're looking at, Karthik?
Okay. So look, from a portfolio construction standpoint, there are two things that kind of aid that scenario, or that two things that will shelter the fund in a scenario where you have market correction. The first is obviously valuation is a reasonable is a sizable input into the model, so that provides a fundamental backstop should things not go to your plan, right? The other thing, as I emphasize, is I just don't look at returns, but I look at returns or expected returns in conjunction with risk. So if a stock is offering possibly high returns, but it is also comes with higher risk, then I may actually go in favor of another stock that probably gives you lesser return, but at substantially lower risk. So risk is a fundamental construct here. And as I mentioned, the beta of this strategy has been consistently lower than 1. So those are the parameters that should help the fund should we go through a reasonable market correction.
Sure. Mr. Rahakrishna Saha asks you, Karthik, the trend has been downwards over the last 3 weeks or so. Is this trend something that has been affected by macroeconomic factors, or do you think this is just technical rally?
Hey, to put it into context, we've had a fairly strong rally over the last 3-4 months, and markets seldom go one way in any direction. So, given that we've had a strong rally, it was only natural for markets to take a breather. Now, you could attribute it to technical reasons, or you could attribute it to concerns around interest rate policy in the West, and that feeding through to our markets. But the fact is, the market's taking a breather after quite a strong rally. That's the first part. Second is, I believe we are in range-bound markets for some time because while our earnings season, even this particular earnings season was quite good. From a valuation perspective, as Shane, you hinted at previously, we are not exactly cheap. We are not extremely costly, but we are not at the lower end of the spectrum as well. So what that means is that we are more likely to be range bound in the near term than probably go on a tear from here, given that we've already sitting on reasonable gains for the year so far.
So we should temper our expectations. We should, if someone's coming into the fund, right?
We should temper expectations at a market level, but that doesn't mean you can't have stocks that offer you good returns. Because I would argue in markets where the market level return is, let's say, high single digit to low double digits, we as stock pickers tend to do better because the stocks tend to give you a wide range of returns. So if you look at a year to date, you've got stocks in cap goods and other sectors that have rallied in let's say strong double digits, whereas you've got IT for the most part, which was slightly negative to zero. So the dispersion is huge. But whereas when you've got a market that's up 30%, pretty much every sector, every stock is up to the same degree. So the stock selection opportunities in market like this is actually a lot more lucrative from a portfolio manager standpoint, as against the market which is going one way, which is strongly going in one way, right? And that is evident from the performance that we've shown for the year so far.
Great, Karthik. I mean, this actually flows in very naturally to my next question. How is it that you would identify, say, you spoke about the cap goods versus a technology or any other such sector. How is the fund or the algo that you're running able to decipher one versus the other? Can you elaborate on that a little more?
Yeah, so that's a great question, actually. So what we do is we are doing bottom-up stock selection. Now, most people think quant is top-down. Well, you can have varieties. Just like a fundamental manager can be top-down or bottom-up, a quant process can be top-down or bottom-up as well. In our case, we are completely doing bottom-up stock selection process. So what happens is typically there is an industry effect and then there is a stock effect. So what I mean by that is, let's take autos, for example. Because the demand environment has been so good across, let's say, across the SUV space, all auto OEM players have benefited, and subsequently, a lot of the auto ancillary industries have also benefited. We pick that up from growth signals at a company level. Now, when you see a lot of these companies within the same sector starting to report good growth numbers or starting to show good growth expectations, then these stocks automatically become part of the portfolio. But what we do from a risk perspective is make sure that our sector exposures are under control. So that is how we build our sector exposures. We are not here to make a call saying that sector A is better than sector B, but typically what happens is when a lot of the stocks in sector A start looking good, then we obviously have start increasing our exposure to sector that particular sector. Classic example will be how we are positioned right now, which is like if we have a lot of the cap good names are looking good, so we have a lot more exposure to industrials. Whereas on the other extreme, you've got IT names that are looking bad, which is why we do have exposure to IT, but is at the lower end of the spectrum. So that is how typically these sector exposures play out. It's more through a stock selection impact rather than a sector call.
Sure. Another very pertinent question from Namit Arora here. Do you ever foresee the strategy going into cash? Is there a statistical possibility there, or do we remain fully deployed at all times?
The strategy will, for all practical purposes, be fully deployed. The aim here is to generate outperformance through better stock selection. So we will not have substantially higher cash allocations. We will only have cash allocations to the extent that is permitted within the investment mandate. So we don't see cash allocations going up substantially other than that.
Yeah. Okay. And in terms of your stock count, do you foresee a narrowness market playing into your hands, a broadening market playing into your hands, and does the model work either way in kind of adding stocks or reducing stocks to the portfolio?
So that's a great question. Typically, you benefit in a quant process from and I would argue any process for that, when the markets are not narrow but markets broaden, is when you benefit. Because at the end of the day, the whole point of having, let's say, 30 stocks or 40 stocks in your portfolio is, firstly, you think you're identifying stocks that can add in terms of return, and there's a diversification benefit. If the market's not going to give you that diversification benefit, then there's no point in having those 40 stocks, right? It is very difficult to outperform in that space. Case in point is what's happening in the US today, where bulk of their returns have been generated by 4 to 5 stocks. So if you had it, that's great. If not, then it's been a difficult environment to sustain to live in, right? So the strategy will do well when the broader market, when there is broadening of the rally and it's not concentrated to a few stocks, and that's when it does well. In terms of stock holdings, typically over the last 2 years, we've held the portfolio has had between 40 to 55 stocks, and right now we are close to 44, 45 stocks in the portfolio.
Sure. In a world where AI and machine learning is playing a ever increasing role, Karthik, and a lot of our competition, both across mutual funds, PMSs, and also, of course, structured products, a lot of people are now enabling some degree of quantitative investing. How do we see ourselves as, say, different? I know you track this market very closely. So how do you see us standing out consistently as compared to the rest of the market?
So just like no two growth managers or no two growth value managers are the same, similarly, no two quant processes are the same. There is a lot of details in any particular aspect that you construct. For instance, let's take price to earnings, right? If I were to calculate the price to earnings ratio, and you would think it's quite straightforward. But the question is, will you use earnings based on historic numbers, or will you use earnings based on forward numbers? If you agree on that, let's say we agree on earnings is going to be based on forward numbers. Will it be based on long-term growth rate, 1-year growth rate, 2-year earnings? How is that going to be based? And if you think that is just a part of this problem, then you take a look at the numerator, which is price. Is it going to be based on month-end price, average prices? How are you going to use that price component? Once you've defined your P/E ratio, will you compare it across sectors, or will you compare it within a sector? Because one could make the point that consumer staples will always be expensive, so compared to a commodity name. So would you want to compare it across sectors? Or maybe there's a case to just look at P/E ratios within that particular sector. There's no right or wrong answer to this. What I'm trying to say is a quant process is much more evolved than just looking at a certain number, and there is a lot more details to it. which is why every process is different. In our case, why I think our process is different is I've built it completely from bottom up. We've used that data, we've taken raw data and built up all these processes. The software has been completely built in-house. So we've completely created these building blocks, and we continue to work on new data, continue to evaluate new data and new signals in an effort to improve the model and the portfolio construction process. So it's an ongoing process. So the work of a portfolio manager in a quant process is basically to look at avenues to improve the stock selection process and the portfolio construction process, which we are fully committed to. And that's how I think we differ from a lot of the competition out there.
Sure, sure. A very valid point that one of our partners makes is the outliers can make or break a portfolio, and you would agree with me on that.
Yeah.
How do we optimize our portfolios and weed out the outliers, especially in cases like, say, IPO stocks, or you highlighted in one of your other answers change in management. How do you is there a manual intervention there?
Okay, so what we do is, so there are outliers. I can look at outliers in a couple of ways, right? One is outliers from a data perspective, because data tends to have extremes. So how do you look at stocks with have outlier data from a data perspective? So let's say you've got earnings that is negative. So how do you calculate P ratio? How do you compare it to another stock that has a low P? So things like that. So that is much more structured, and there is a process around it. There is a way of how you deal with that data, and there is a statistical process, a mathematical process of how you deal with that anomaly, which is what we do. When I said we built everything process in house, that is the benefit, because we are taking all those anomalies and addressing it as it should be addressed, and that's one of the strengths. So that's how we do it when it comes to anomaly with regards to input data. Now,
is that a manual process, Karthik?
It's not a manual process. It's a mathematical process, and you identify where the anomalies are, and then you write rules around them to kind of address this automatically. Because at any point of time, we are looking at 350 stocks, so you possibly cannot look at 350 stocks across multiple data points to see where the anomaly is, which is where you need to build a solid process in place. Thanks for highlighting that. Second thing, with regards to stocks, yes, if we hold a stock, let's say we hold a particular stock and that has had a development that cannot be captured by numbers. So let's say the management has gotten legal trouble, or there has been other issues around management which cannot be captured by numbers. Now, if that were to happen, then you know that the stock price is going to react to events around that rather than the business fundamentals. Now, this model has no expertise in predicting which way a legal fight is going to go. So in cases like that, if we hold that position, I will exit that position, go to cash, and run the model again to figure out where to invest that cash in. So that is one exceptional situation where we could make a call there, and which is why I said it is automated for all practical purposes. But at the end of the day, we are constantly looking at that portfolio from a risk perspective to make sure that the portfolio is well managed. So in instances like that, we could make a manual call of exiting a position and then going to cash. But I will never make a call of saying that I like stock A, whereas the model doesn't like it, so I'm going to put it in my portfolio. That will never happen. The manual intervention will only happen if I own a stock in the portfolio and there has been a development that's not positive for that company and cannot be captured by numbers, in which case I could make a manual call. So I really mean when it is exceptional, because we've had very few cases over the last 2 years.
Yeah. Going back to fundamentals, Karthik, Yashod Menden asks, is it fair to say quant is timing the market? And if so, how is debt, cash, and other elements in the fund used to play in the market?
Okay. I linked it to my previous question, which is like this product is not about market timing. As I said previously, we don't make cash calls, and this is a purely equity offering. So I'll just reiterate for this benefit of everybody. This is a purely equity offering. There are no other asset classes. Second is that we are not making cash calls, and we are not trying to time the markets.
And you don't use derivatives, right?
Yes. And all we are trying to do is, like a traditional fund manager, we are trying to generate outperformance over the markets by bottom-up stock selection. Even the philosophy is very fundamentally oriented, which is quality and growth at reasonable prices. But the difference is I'm using data and extracting signals from data to get to my destination. It's just which car you're driving to the destination. You're driving a Hyundai, or you're driving a Kia to that destination. But the destination is the same. It's just that I'm using different means to get there.
In terms of the track record that quant funds have had, they've not been the best over the last 15 odd years. A lot of discredit has come from the fact that a lot of fund managers have been curve fitting to factor in a variety of problems that have arisen over time. Can we assure our investors that we do not do curve fitting? And if so, what are the checks and balances we put against it?
Okay. So as I said, I've had the experience. I've been doing quant strategies for almost 14, 15 years. And so the question is very pertinent in the sense that one could easily fall into the trap of curve fitting, which is where our expertise or my expertise comes in when I'm building the model to make sure that I kind of avoid these traps. And not just curve fitting, but there is also a question of other biases that I have to avoid while testing the model and while evaluating different signals. So that's something that I consciously do at my end when we design these processes. So that's the first part. Second, though, what I would want to highlight is every product will have its cycles. It will have its good cycle and it will have its challenging periods. So from an investor standpoint, what I ask for is discipline and investing for a longer term horizon, so that you are better off over the cycle and you're not trying to time these cycles. So that's a request that I would have from the investor to make essentially to stay invested for a reasonable period of time. And
that period should be about 3 to 5 years, correct?
Absolutely. So curve fitting is something that going back is something that we consciously avoid in our research process, and that's our expertise, and that's what we do for a living.
Sure. A couple of numbers that I wanted to rattle off, Karthik, from the rules. What is your max sector allocation? What is your single stock weightage cap? And what is your average time or age of a particular stock in a portfolio?
Okay. Can you repeat the first question, please? Sorry.
Yeah. What is the maximum weightage you allocate to one particular sector and one particular stock, and the average time one stock will remain in your portfolio?
Okay, so with regards to sector, it depends. It is not an absolute. It is not an absolute limit. What we do is as I said, the aim is to make sure that the portfolio doesn't take extreme sector bets. So what we do is we align ourselves. We look at it vis-a-vis the benchmark, and we make sure that it is at a certain range around the benchmark. So typically, let's say IT is around 14% of the benchmark. Then if the model likes IT stocks, then at max we could go up to 21, 22%. And the model hates IT stocks, which is the case today, or rather dislikes IT stocks, to temper it down, as is the case today, then we'll still have an exposure of 5 to 6% in that sector. So that's broadly the range that we are looking at from a sector perspective. Now, with regards to your question on a stock level, there are limits at a stock level, and it's not uniform. It depends on the liquidity of the stock. So higher the liquidity of the stock, higher can be the weight of the stock in the portfolio. And conversely, lower the liquidity of the stock, lower will be the weight of the stock in the portfolio, irrespective of how much the model loves the stock. So even if, let's say, the model ranks the stock as the best stock in a universe of 350 stocks, if the liquidity is not available, which means that the stock level limit will be quite low. And on the contrary, a very liquid large cap stock will get a larger limit. So there is no one answer for it, but it depends on the liquidity of the stock. Now, with regards to average holding period in the portfolio, as I said, the turnover of quant funds tend to be slightly higher than traditional funds, around 140 to 150% in our case. So you are looking at a holding period of average holding period of around 7 to 8 months. But I would like to caveat that by saying we've had a few stocks that we've held since inception of the strategy. So that's almost like 1.5 to 2 years we've held those stocks for that period. And at the the same time, there are other stocks where we've kind of gotten and got out in a period of 2 to 3 months. So average holding period is 8 months, but then at any particular stock level, it depends on how the fundamentals of the stock are evolving, and that's what decides holding period at a stock level.
Sure. Sure. So I'll take a step back, Karthik, and talk to you a little bit more about markets and get your take on the markets thus far. So we had a good 6 months, and driven by the revival of FPIs, India gaining disproportionate market share amongst the rest of the world, especially in the emerging markets. The next 6 months, you did mention that we should temper our expectation. What are the triggers to take markets higher or lower, in your opinion?
Okay, so I'll start with the part where markets have obviously had a rally. So in keeping with the theme that we should temper our expectations on the lower side. Look, there is still a lot of policy uncertainty that's coming from the West. If you look at US and other developed markets, while inflation is coming down, it still remains higher than most central bank target levels. So it's still high up there. So we don't know if how much rate hikes we are going to see. And the other catch is, you don't know what the trajectory is in terms of how long will they keep those rates at those levels for, and subsequently how quickly they will cut those rates. So there is a lot of uncertainty around policy, and that filters through to our markets as well, because at the end of the day, capital is fungible, and there's a cost of capital, right? And as long as that cost of capital remains fairly high, it means that it could have a negative effect on markets across the globe. And you're seeing US dollar strengthening on the margins, and there are a couple of emerging markets under stress as well. So there is a lot of policy uncertainty that could weigh on our markets, and that would cap the upside. The other thing, if you look at domestically, while we have had a reasonably good earnings season, our earnings expectations for next year is one of the highest in the regions, barring, I think, Taiwan and Korea. And even with Taiwan and Korea, to give you a background, they had negative earnings last year. So they are coming off a lower base, whereas we are coming off a much higher base, and we still have strong earnings expectations. And then we are at reasonable valuations. So all those things kind of put, at least in the near term, they put like they put a cap on the upper side. But having said that, the downside is also quite strong, because our earnings visibility is quite strong. As you said, FPIs continue to love our markets, and especially given the uncertainty that we are seeing in Hong Kong and China markets, probably that will continue to stay. That will continue. That theory will continue to hold, and so we have strong downside support as well, which is why I think our markets is more likely to be range bound, or will see time correction over the next 5 to 6 months. But that doesn't mean that we won't find stock-specific opportunities. So at the end of the day, we have to differentiate between the two. What is your headline indexes saying? Because the headline indexes are obviously dominated by a few stocks and a few sectors. And then what are the opportunity sets? What is the opportunity set beneath that index level? And as we've seen the year so far, at least, there is a lot of opportunity at a stock level, and that index level returns may just hide it, right?
Understood. So in range bound market, Karthik, how do you suggest one participate in the quant fund? Do you think there are opportune times wherein you can put lump sum money in, or just stay the course, just keep allocating through a systematic investment plan?
Okay. I think for the most part, timing the markets is quite difficult or close to impossible. So I would urge everybody to be much more disciplined. And so to that extent, systematic plan probably fits in better. But that also gives you an opportunity. If the market corrects reasonably and you see good entry points, maybe that's the time you allocate a bit more to the markets or to Access Quant Fund in particular. But I think for the most part, start out being more disciplined. But being disciplined gives you that opportunity, because you always have capital on the sidelines to deploy should the market correct, right?
Yeah.
So that gives you that flexibility as well.
Yeah, sure. I'll switch gears again, Karthik, going back to the fund. So one question. So I think Amit, is fairly negative on the markets. If the markets were to correct 20%, how would Quant Fund fare? The Axis Quant Fund fare?
Look, to give you Amit, to give you a absolute number would be quite difficult because it depends on it depends on circumstances, right? Which is where the process matters. So if you are evaluating the fund, then evaluate from a perspective of evaluate it by looking at the process. So as I said, two things. The beta of this strategy has been consistently lower than 1. It has been materially lower than 1. It's ranged between 0.87 to 0.95. So there you have a lower beta. Second thing, when I put the portfolio in place, the risk is I just don't take return into account, but we also take risk into account in sizing our positions. So what I'm trying to tell you is we look at not just we are looking for a portfolio. We are trying to construct a portfolio not only for highest return, but on the contrary, we're looking for optimal. We are looking for an optimal balance between return and risk. So, which should put this fund in a good position should you see a correction in the market of those levels. But I wouldn't be able to give you an exact number. I hope we never do if we don't see that experience, but we are well prepared for it should we see that level of correction.
Sure. Just to add on, Amit, Karthik did mention about beta. Beta is a very important indicator, just from a concept point of view. Higher the beta, the higher is the aversion of the fund to perform one way or the other as compared to the benchmark. So let's say, for example, if your beta is 1, you more often than not will trend with the market in near symmetry. But if your beta, like Karthik mentioned, is say 0.9 or 0.8, then for every 1% move, you would typically move up 0.9, or vice versa. When the markets go down 1%, you would probably fall less to about 0.8 or 0.9. So beta is a very, very good indicator, especially when we're talking about quants and various risk ratios. Karthik also alluded to volatility of the fund. That can be monitored using the standard deviation. It's a very, very powerful indicator to say how consistently your fund is able to navigate fairly volatile markets. So lower the standard deviation, the better it is from a fund management perspective. I believe that's all the time we have, Karthik. Thank you so much for spending time with us. As always, to investors, if you're looking to learn a little more about the fund, we've got a wonderful mobile app. The Axis mobile app is available on the Google Play Store and the App Store. We also have a website. It's called www.axismf.com. You've got the complete information, including portfolios and snippets from Karthik about what the Quant Fund is. Please do take the time out to read some of that material before you invest. It'll give you a lot more perspective and a better understanding of the fund itself. With that, we will close today. Thank you so much for your time and good evening.
Thanks,
and
thanks, Shane.
Happy weekend. Yeah.
Thanks, Shane, and thanks everybody for joining in. If you have any questions on the product, you know the channels to reach out to, and we'll be more than glad to answer any queries on the product or the process. Thank you. Thanks, everybody.
Great. Thanks, everyone.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.